This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on swing trading examples. I'm going to be using the 5-minute chart to illustrate some examples of swing trades, and then I'll move on and talk a little bit about a failed bull breakout. Most swing trades begin with a very strong trend bar. We have a very tight range here and a decent sized bull bar, not all that big compared to what followed, but when this bar formed, you don't know what's going to follow. We have a doji bar after the bull breakout bar, so the absence of a bear bar. Even though it has a big tail on top, the odds are we're always in long and will go at least a little bit higher. Traders can buy the close of that follow-through bar. If they want higher probability, they can wait to see a series of bull bars. Here we have another bull bar with a decent-sized body. It still has a big tail, but the next bar has a bull body as well. So there again is acceptable follow-through after a decent-sized bull bar. Traders will buy above the high of the prior bar, or they'll buy the close of the prior bar. If they buy above the high, they get filled on this bar. That inside bar is a pullback from the breakout above the high of this bar. At this point, we have a rally, a sell-off, a rally, a pause, a rally, a reversal. We have 3 pushes up. Therefore, it's a parabolic wedge or a micro wedge. It's okay to exit below the low of either this bull bar you get out here or exit below the low of that bar. The market's still always in long, so this is probably a minor reversal, which means a bull flag or a trading range. If a trader does exit below that bar and they want to trade from an always in perspective, they have to buy again above a bull bar. For example, above this bull bar here, they get long here. Many traders do not want to exit on a minor reversal. A very tight channel, a 7-bar bull micro channel, the first reversal down probably will result in either a bull flag or a trading range. Many traders will hold long and rely on their stop below the bottom of the initial rally. If a trader did exit on the parabolic wedge top, below the low of that bar or below the low of this bar, he has to be looking to buy again above a bull bar. And we have a small bull bar here, so he would buy above its high and get filled there. Alternatively, he might want to buy on a stop above the top of the parabolic wedge, arguing that if the wedge top fails, the bears give up and will go up for some kind of a measured move, maybe based upon the height of the wedge. Other traders will buy the close of the strong bull bar or the doji bar that followed it. The follow-through bar is not a bear bar. Odds are if you get a decent follow-through bar after a decent breakout bar, you're going up at least a little bit higher. Chances are after a breakout this strong, we're going to get a second leg up after a pullback. If you buy above the high of this bull bar and get filled here, or if you buy above the high of this bar and filled here, or if you buy this close or that close, by the close of this bar, you're going to move your stop from here to here. A strong breakout to a new high, closing at a new high. Traders do not want the market to fall below that low. This is now a major higher low, and as long as the market continues to make major higher lows, it's in a bull trend. It's still always in long. If it falls below that low, the premise of a bull trend is no longer valid and traders will want to exit. And therefore it's reasonable to raise the stop from here to just below the bottom of this strong bull breakout. We have another parabolic wedge, one reversal, second pause into a doji, and then third possible reversal. But very strong bull breakout, more likely If we trade down 5 to 10 bars in a tight channel, it'll be a bull flag and we'll get some trend resumption up. We have a bull breakout above a wedge, and we're right around a measured move up. Therefore, some bulls will take profits. Aggressive bears will scalp, but when a channel up is as strong as this is, with only a couple small bear bars, chances are the first reversal down will fail and the market will go higher. Consecutive buy climaxes here and then here, and these 5 bars make another buy climax. Buy climax here, buy climax here. We might get a 10-bar two-legged pullback before the buyers are willing to buy again. Again, if you exit below any bar, for example, below this bear bar, it's basically an II. This is slightly above that high, but it behaves like an II. If you do exit your longs below that bar, you have to be prepared again to buy above a bull bar, like maybe above that bull bar. This did not flip the market to always in short. It simply tested the bottom of the most recent buy climax bar and then went sideways to a small double bottom. We're still always in long. If bulls exited, they have to buy again above a bull bar, expecting at least a continuation of the trend. A lot of bulls will simply hold long and they'll simply rely on their stop down here. It's okay to take profits, a parabolic wedge, a second leg up from this breakout, 1 pullback 2, and then we have a pair of bear bars, almost an II pattern with bear bars. It's acceptable to exit longs below that second bear bar, the inside bar. However, if you do, and you are trading always in long, the market's still always in long. This did not make it short, and therefore you have to buy again on a reversal up, preferably above a bull bar, like here, and you'd get long just above its high there. At this point, we have 3 consecutive bear bars, 2 closing below their midpoints, but they're not especially big. A lot of traders will exit when there are 3 consecutive bear bars, thinking that we'll get at least a couple legs sideways to down and possibly a reversal. If they do take profits, they'll look to buy again on a reversal up, especially a double bottom, a high 2 with a bull buy signal bar, as we have right here. Tight trading range, breakout mode. You can argue 50-50 chance we'll have a bull breakout, 50-50 chance we'll get a reversal down. That's not entirely true. Even if you get a 20-bar or 30-bar tight trading range, the odds always slightly favor the trend before resuming than reversing. And therefore, even though every bar that gets added makes the probability closer and closer to 50-50, bulls and bears, the bulls still have a slight probability advantage. Now we have a double bottom bull flag around the bottom of this buy climax bar, a support level. It's also holding at or above the bottom of that most recent buy climax. If you want, you can call it a triangle. We sold down from this doji to that low and reversed up again, trying to reverse up a third time. I would simply call it a double bottom bull flag at the support of the bottom of the most recent buy climax bar. We have a double bottom bull flag, reasonable to buy above the high of the bull bar, and then you get filled right here. If you prefer higher probability, you can wait to buy until you see a pair of consecutive bull bars closing near their highs. This is a breakout, a 2-bar breakout of this bull flag. Chances are we'll get at least a small second leg up. It does not matter where you buy. If you bought here, or this close, or that close, below that bar, above this bar, any of those trades have the same stop at this point, below the bottom of the most recent strong bull breakout. We have another breakout, always in long still. Bulls will buy above bull bars, especially if they get a double bottom bull flag. There's a small bull bar here. They'll buy just above its high there. Even though the bars are small, it's becoming a buy the close rally. 3, 4, 5 consecutive bull bars. Traders will buy closes if they're flat. Some traders will take several closes and add to their position. Most traders would rather just get long and take one or two of the entries and not worry about all of the others. Once you get a series of bull bars, 3, 4, 5 consecutive bull bars, even though they're strong, traders will raise their stop up to below the most recent bull breakout. So the stop will be right here, below the low of this small bull leg. The height of the entire first leg up led to a measured move up right here, and you can see that traders took profits there. And then toward the end of the session, the US session, the market entered a 10 or 20 bar tight trading range, again in breakout mode. The premise of a bull trend now is much less. We've been sideways now for about 30 bars, probably not going to go very far up or down for the remainder of the session. Reasonable to take profits below a bear bar, get filled on this bar right here, betting that it's a wedge top, 1, 2, 3, and that the premise of a bull trend is much less valid, and more likely we're simply going to continue sideways. I'm going to continue with the day trading examples by talking about a failed bull breakout. We have a weak bull trend, and now we have consecutive bull trend bars closing at or around their midpoint. This bar, though, has a pretty big tail. This bar has a fairly conspicuous tail as well. This is the open of the US session around 5:30. Sometimes it's 5 o'clock, sometimes it's 6 o'clock, sometimes it's somewhere in between. You have small bars at the end of the European session, and now we're starting to get big bars, and that corresponds to the beginning of the US session. We have a gap. We have a close of this bar above the high of that bar, and then we have another bar. Its close is above the high of the prior bar and the high of the breakout point. Is this going to be a measuring gap leading to a measured move up, or is it going to be an exhaustion gap leading to a pullback below the breakout point and closing the gap between this close and that high? In general, whenever you have a strong move on the open of any market, 50% chance it's going to reverse, 50% chance it's going to continue. From this leg up, we have a measured move right here and a big sell-off from that price level. Bulls are taking profits, bears are shorting. This could be simply a buy vacuum test of that price level and a type of parabolic wedge. 1, 2, 3, breaking above the wedge and reversing down, or 1, 2, 3. Different computers use different prices. This breakout is the biggest pair of bull bars in the entire 50 or 60 bars that you see on the chart. Whenever a market has its strongest breakout after 20 or more bars in a trend, the odds are it's more likely an exhaustive end of the trend than the beginning of an even stronger bull trend. Again, the tails on tops of the bars, especially the second bar having an even bigger tail and a close below its midpoint, that is a problem. It represents bulls taking profits and aggressive bears selling. You can draw channels different ways. I can draw a channel here, a bull breakout. I can draw a channel here, bull breakout. And I could use these highs to draw a channel as well. Because most breakouts above bull channels fail, there's a high chance that this bull breakout is going to fail, especially because of the two big tails on the tops of the bars. Therefore, an exhaustion gap is more likely than a measuring gap. Exhaustion means we'll pull back below the breakout points, this high, that high, maybe down to the bottom of this bull breakout. Better to not buy closes, instead wait to buy near support. This bar is a problem for the bulls. It has a reasonable bear body closing in its lower half, and it totally reverses the bull body here. This might be an exhaustive end of the rally and the beginning of a swing down. It is a possible opening reversal and early high of the day. A two-bar reversal, up, down, but a fairly big tail below is still possible if this bear bar is a pullback from this bull breakout. However, bulls do not want to see a decent-sized bear bar after a bull breakout, and they don't want the bar to be closing below its midpoint. Can you sell below the low of that bear bar? You can certainly sell out of longs. Aggressive traders will sell short, betting on a wedge, 1, 2, 3, and a bull breakout above the top of a channel that is failing. But that prominent tail on the bottom of that bear bar makes this more likely the start of a trading range, less likely the start of a bear trend. Bears will look to sell short on a stop below that bear bar, two-bar reversal, and fail breakout, 1, 2, 3, or 1, 2, 3. If they take the short, their stop for a swing down is above the top of the bull trend. Some traders do not want to risk that much if the stop is too far. Those traders often will use a tighter stop, like above the 50% pullback, allowing for this to pull back 50%, but not wanting it to pull back more than 50%. You could put the stop just above a 50% pullback, which this is. You get short here. There's the stop. This is slightly above a 50% pullback. Other bears will sell short below this bear bar and put a stop a pip or 2 or 3 above the top of the bear bar. Again, you can put a stop here. You can put a stop there. This stop is further away. That means your risk is greater. Whenever you have a choice between two stops and one is further, the risk is greater and the probability of making money is greater as well. You'll lose less often, but when you lose more money. If you're choosing between two reasonable stops and take 100 trades, the final profit will be about the same. With a tighter stop, you lose more often, but you lose less. With a wider stop, you lose less often, but you lose more every time you do lose. Here, the market sold off below that bear bar, and after 2 or 3 bars down, traders will assume we're going at least a little bit lower. If you want a higher probability short than selling below this bear bar, you wait for 2 or 3 or 4 consecutive bear bars, and then you sell closes, either this close or that close, betting that if we reverse, there'll be sellers above and we'll get at least one more leg down. The trade-off, selling late with the stop now very far away, higher probability. It's usually a reasonable alternative. Some traders will sell with a stop 2 or 3 pips below this bull breakout, betting that will fall for a measured move down. Other traders will wait for a strong bear breakout. This bar closed below the low of the past 50 or 60 bars, a reasonable short, closing on its low, or they'll wait for a bear bar after the breakout bar and sell the close of that bear bar, a follow-through bar, betting that it now has a higher probability of falling for a measured move down. Every bull trend bar. Every series of bull trend bars is a breakout and a climax. We have bear bars, and therefore it's a sell climax. We have a pause, doji bar, and now we have another sell climax. If you start to get a series of sell climaxes, the market usually tries to get a reversal. We have a bull body here, but it's only a very small bull body, probably not enough to reverse a strong bear trend. Probably sellers above the high of this bull bar for at least a small second leg down. You can construct a wedge using that low, first reversal down, second reversal down, and then a third push down. If you want, you can call it a parabolic wedge, where around a measured move down based upon the height of the original bull breakout, the high of the bull breakout, the low of the bull breakout bars, and measured move down. So this is a support level. And now we have a possible parabolic wedge, but not a very convincing one. We have a micro double bottom. We went down on this bar and then down a little bit here and up. It's not an II, but it's a pair of consecutive doji bars. Can you buy above the high of these two small bull doji bars? With a channel as tight as this is probably a minor reversal. It'll probably lead to either a bear flag followed by another leg down, or a trading range followed by another leg down. After a strong bear breakout like this and then a second leg down, a lot of traders will tighten their stops from above the top of the bear reversal to above the top of this big bear bar. It's also more than a 50% retracement from the high to the low. Starting to reverse up, we have a double bottom here. We're testing the breakout point below the bottom of this rally, and we're breaking above the top of this triangle. We went up and down, up and down, up and down. In general, a bull breakout above a tight trading range or a triangle, 50% chance it'll fail, 50% chance it will succeed. Many traders will buy the close, betting it's going to be a measuring gap. Many other traders will sell the close, betting that the bull breakout will fail. In general, if you have a tight trading range and a breakout, 50% chance it'll be successful, enough for a profitable buy, 50% chance it'll fail and reverse. Therefore, bears will sell that close, put a stop maybe above this bear bar, maybe up here, looking to scale in higher. You can see the bad follow through after the bull breakout, and some traders will sell below the low of that bear bar and get filled here. The bears who exited on the reversal up above this triangle will look to sell again either below this bear bar or a second entry short below this bar. Weak rally, the lack of consecutive big bull trend bars, consecutive bull bars but not big, 3 consecutive bull bars but not big. This is probably a bull leg in a trading range, in other words, a bear flag. And therefore, swing traders who sold for any reason can continue to hold short, stop either above this big bear breakout bar or above the top of the bear trend. Bears will look to sell a reversal down. They see the rally as weak and therefore a bear flag. They'll look to sell below bear bars, especially a second entry short. Some bears will keep their stop all the way above the top of the initial sell-off, although this is reasonable as well. If you get stopped out and it reverses down, traders will look to sell again. And we started to enter a very tight bear channel. and fell to a new low of the day. Fairly tight channel, and now we're getting a bear breakout below the channel and a bear breakout to a new low of the day. Most bear breakouts below bear channels fail and reverse. Weak bear channel, the absence of consecutive big bear trend bars, much weaker than this, a lot of sideways bars, a lot of small bars, prominent tails. This is probably a bear leg that will end up being a leg in a trading range. And a bear leg in a trading range usually leads to a bull leg in a trading range. And therefore, traders selling or waiting for a signal expect a bull breakout of the bear channel. Here we have a bear breakout first. You can also argue that it's a wedge, reversal up, second reversal up, possibly third reversal up. So a wedge bottom, expect a bull breakout. Fairly big sell climax relative to the past 20 or 30 bars, possibly an exhaustive end of the selling, and it will lead to a reversal up instead of a measuring gap and a measured move down. The bears who sold see that it's a weak sell-off, and therefore they'll look to buy back their shorts at a new low, so this general area, especially on a reversal up. Bears can exit either above this doji bar or second reversal up above this bar or above that bar, or once it starts to become a small buy the close market, a lot of the bears will buy closes as well, exiting, trying to preserve profits or minimize losses. In this video, I gave day trading examples on the 5-minute chart. I also gave an example of a failed bull swing. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This was the second of 5 videos on swing trading.